Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Tuesday, August 25th, 2020. And our top stories today: big tech's dominance of big business soars, and fintech declares victories in PPP loans. Well, joining me now to discuss this and more is Daniel Klein. He's Senior Technology and Consumer Products Reporter with The Motley Fool. Dan, welcome back to the program. Great to see you this morning.
Hey there, Jeff. Thanks for having me.
Yeah, it's great talking with you. Love our tech chat on the podcast. Love carrying it over every Tuesday here on the network. Let's jump in because what's interesting is we had the PPP, the Paycheck Protection Program loans, and it looks like a lot of the technology companies kind of got into the marketplace. I'm thinking about Cabbage and others to really help push out some of these loans. But what can you tell us here?
Yeah, banks weren't set up to deal with the volume here, and they got maxed out really quickly, whereas technology companies can scale. So I use a payroll company. I won't say which one because they're not an advertiser here, but they were back when we accepted advertising on our podcast at Motley Fool, they were an advertiser. That's how I heard of them. And the second this was made available, every time when I went in to do my payroll, and my payroll is just me, it would say, hey, do you want to apply for a PPP loan? And I've been lucky enough that I've worked steadily through this, so I haven't needed to do that. And I've had lots of small business friends say, hey, look, I went to my bank and I filled out the paperwork and I didn't get it. They didn't process it. They ran out of money before it was processed. That's just, banks were not set up to deal with this sudden rush, and technology can adjust really easily.
And I agree with you. And it actually was to the detriment of the small businesses who needed the money. You have 100,000 businesses or more that had to shutter or are shuttered permanently right now, Dan. So they were, in a way, denied access. You know, people who have big staffs can go and wait online and make the phone calls, or they have banking relationships to really help them here. But, you know, as part of the larger conversation that you and I have had since the beginning of the network and on the podcast, it's just an example where the agility, the innovative nature of fintech, of technology, really is way ahead of these financial institutions, these asset managers, insurance companies, et cetera.
Yeah, a physical bank can't really ramp up. And even, so take Wells Fargo, that's where I bank, and they're a pretty typical bank, and they have an app, and their app is fine, but adding new features to an app is difficult. They're not built that way. They're built based on branches. And you look at technology first companies, and adding a new feature isn't that daunting. Scaling isn't that daunting. You look at something like, we're doing this over Skype, but I do a lot of my daily work over Zoom. Yep. Zoom went from 10 million people to 200 million people in like the blink of an eye. And were there some minor issues with security? Absolutely there were. But imagine if I went to Wells Fargo and said, well, you're serving 10 million customers a week. Now you're going to serve 200 million customers a week. That simply wouldn't work. And technology is built to scale. There's all sorts of companies out there like Cloudflare, like Fastly, designed to help you scale that you can plug in. There's no magic company that can build a bunch of new bank branches. And that's not going to help you anyway, because it's not, we can technically go to the bank now, but everything is limited capacity. Everything is social distance. Technology is the solution here, and it's been an absolute savior for people with PPP loans. And the problem is some small businesses don't have access. And we've had the problem with this whole program where who's eligible, who should be getting it. In the beginning, there was a lot of furor over the fact that Ruth's Chris took a PPP loan. But if Ruth Chris took that loan and used it to not lay off employees, why are those employees any less valid than the employees of, a family-owned small business? There should have been criteria. Potbelly, the sandwich company, didn't take the loan at first, and last week took $10 million. Well, if they're doing that to keep franchises open, I know the Potbelly near the Motley Fool office is a common lunch spot. I don't want that to close. I'd like it to still be there for my coworkers when that happens. So this is all really tricky, and technology has been a big part of, let's call it the limited success of this program.
Dan, we talk about banks and not being able to innovate at least as quickly as financial technology. So there's acquisition opportunities, or mergers and acquisitions, I should say. And you just look at American Express purchasing Cabbage. I think that was announced last week. And just want to get your thoughts there. Obviously, that's signals that American Express, which I think is pretty forward thinking. They have a pretty decent web presence. I don't use an American Express card anymore, but they have other services. But now to partner with a Cabbage to deliver loans, maybe not necessarily PPP loans because that program is kind of concluded, but this kind of signals to me that there's some marriages out there that could happen.
There absolutely are. So I'm going to try to say this diplomatically because I really like American Express. And we've talked about this before. I have an American Express Platinum card. It has a ton of travel benefits, the best of it being the American Express lounges, which are wonderful if you're traveling. You know, basically restaurant quality food, showers if you need to take a shower, like really comfortable spaces, lots of other benefits on that. So I'm a big American Express fan. I'm not a big Cabbage fan. Here's what Cabbage does. They loan you money against your accounts receivables. That is fine if you're in like a seasonal cyclical business where, you know, if you're loaning money to a toy store in the summer when it knows it's going to have a big December and pay you back, that's one thing. In a lot of cases, this is loaning a business money that was coming in anyway, charging a fee for that, and the business never catches up. This is kind of a payday loan sort of business. I've never been a big fan. Again, there are times it works. I'd like to hope American Express will make it a more ethical business than this type of business. I'm not speaking of Cabbage specifically, has generally been. But yeah, I think there's a lot of room for old world businesses to acquire new world businesses, or the reverse. Look, is there some benefit for, say, an Ally Bank to be purchased by Capital One and then have physical banks? I'm not saying that's going to happen. I'm saying, but if it does, it makes things like the Capital One cafes and the Capital One bank portfolio, they serve more people, and that becomes beneficial. I'm not against physical banks, but I don't understand why we're still building so many of them.
Well, Dan, I think you're just upset that Carl Malden's no longer the spokesperson for American Express. You know, you never leave home without it, and I think he was great. I'm dating myself. I thought he was a great pitch man. Well, Dan, I want to go to a commercial break, and we come back. We're going to talk about the big tech dominance in the world and the U.S. economy. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
If you are like 58% of Americans, you didn't go to college. Or you did, but never finished. Maybe it's the thought of a big, intimidating campus. At Independence University, all classes are held online. Maybe it's the thought of being alone in a sea of students. At Independence U, you'll get a personal support team to help you every step of the way. Maybe it's the cost of all those books and supplies. Online means no books to buy. We even give you a new laptop and tablet to keep when you graduate. Maybe your life doesn't fit typical college classes. At Independence U, our online college fits your schedule. Let's meet a few students.
Independence University held my hand through the process.
Don't be afraid to take the leap because it has changed my life drastically.
Just take the first step and you can do it. If I did it, you can do it too.
At IU, there's no barriers to your degree.
800-535-9916.
Welcome back. We're talking to Dan Klein of The Motley Fool. Dan, thanks so much for staying with us this morning.
Thanks for keeping me.
It's great to have you as always. Dan, we're going to shift gears. And, this pandemic has hurt a lot of businesses, but one area that has really stepped up and done fairly well is big tech. And you see this become more of a portion of something like the S&P 500 and part of the world and the U.S. economy in tandem. Give us your take on this.
Yeah, we talked about this a little bit on the podcast. Apple has become the first $2 trillion company. And look, this is a case where the big are getting bigger. If you look right now, we're all stuck at home. So what are we doing at home? We're watching YouTube videos. We're playing with our iPhones. We're posting laments on Facebook about how bored we are and what we're doing in quarantine. The other one I'll point out that's been really huge is Netflix. This has been a big gain for Netflix. It's been a big gain for Disney Plus. Successful companies can scale, and they're getting bigger because of it. Now, the interesting thing about this is, yesterday, this week, a lot of the big retail companies posted results. And you had companies like Target and Home Depot and Lowe's and Walmart. They all had record results. But you had to say, well, next year, the comparable sales are probably not going to live up to this because we're going to go back to taking vacations. We're not going to spend all our money. How many times can you paint your living room? You're only going to do that so many times. That said, they've acquired new customers. They've built their business better for the long run. And with tech, that's true as well. Are we going to watch 4 hours of Netflix a night, a year from now? No. Hopefully we're going to go out to bars or restaurants and see our friends and do stuff. But that said, did Netflix capture 20 million new customers? Is Disney Plus now over 60 million customers and Disney digital subscriptions over 100 million customers? Yes. And we're going to stay those customers. We're still going to watch The Mandalorian. We just might not rewatch season 3 of The Simpsons, because we have nothing else to do. So these are all really good companies that are benefiting by circumstance.
Dan, to your point, we go back to going to baseball games, bars, restaurants, going out, seeing our friends, having parties, etc. Do you think the dominance, the quickened pace that this has happened, does that subside and regress a little bit so that it's not as dominant? Meaning technology is always going to be there. It is the impetus for how we do things. We need it. It's going to continue to change things. But the pandemic has really accelerated the change. Does it step back?
So it steps back to a point. So let's look at something like getting groceries delivered, whether it's via Walmart or Instacart or Target using Shipt. Right now, some people are doing that for all their grocery delivery. And there are people that didn't use grocery delivery beforehand. Food ordering. My mother didn't know how to use Grubhub before the pandemic, but she knows how to use it now. Are we going to do these things all the time post-pandemic? No, we're going to go back to grocery stores. We're going to eat in restaurants. But just like I did pre-pandemic, are more people going to go, oh my God, I'm busy. I don't have time to go to the grocery store. Let's just place an order. Yeah, that's going to happen. So all of these tech companies are going to have more customers. They may have less customer interactions, but you can't put the genie back in the bottle. Once someone knows how to, look, once you have Netflix, it's really hard to get rid of Netflix. And that's true with grocery delivery. That's true in so many growing digital areas, but it's not going to be the dominant use. Look, we've talked about this before. Digital sales were 13.5% of retail sales in 2019. They're obviously a much larger number now. Did we accelerate growth, and the normal number for digital sales might be 18, 19, even 20% going forward? Yeah, absolutely. But I talk about this all the time. People still like going to stores. The mall's not dead. We've talked a lot about, that's a common storyline. Oh, malls are suffering. They were suffering before this. No, they weren't. Mall foot traffic was roughly close to all-time highs in 2019. Now, mall spending traffic may not be where it was, and we don't know those numbers because other than Apple, nobody reports sales per square foot in their stores. You can back it out from some of the retail reports to say, okay, well, maybe GameStop wasn't doing so well. Well, you know what's going to be doing well this year when the new consoles come out? GameStop, if we can go into stores. So we're going to see a shift in everything. Malls are going to change. There's going to be more experiences. There's going to be more like cosmetical places, more events, more who knows what, bigger food courts. But overall, there's been a push to digital, but that's going to stop at a point. There's only so much. We want to interact. I think if there's anything that the pandemic has taught us is that most of us are social creatures. And this has been painful because the only social interaction we get to have is things like this.
Yeah, or being with our families, or in our immediate families. Dan, I'm going to talk about, let's shift gears a little bit to investing, because there are indices that people invest, and we've talked about, we're not giving financial advice here, but people do oftentimes invest by tracking an index, S&P 500, Russell 2000, blah, 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 blah. How does this overweight to technology in terms of the dominance impact an index? I would think that would overweight, and is that good, bad, or neutral?
So I'd say it's neutral, because absolutely the S&P 500 overweights to technology, and that changes a little bit with Apple's stock split because it's based on share price. But that said, what are the best companies right now? Most of the best companies are technology companies, the high growth, strong conviction companies that you believe in long term. You're going to be overweighted in tech. Now, look, that doesn't mean I don't believe in Walmart. It doesn't mean I don't believe in Target, that there aren't other companies. But realistically, the growth put up by those retailers is something they're not going to be able to match in a normal quarter. Whereas could Apple continue to grow by 10-15% a quarter in terms of revenue? I think that's going to be difficult, but I do think it's possible. Apple is always sort of one good idea away from that massive growth, whereas do I think Walmart Plus is going to be a major game changer that fundamentally alters their business? I don't. So yeah, you're going to be overweighted in tech. If you look through the various Motley Fool recommendations, if you're a member of even our least expensive services, they tend to be pretty tech driven, because that's where the opportunity is. I mean, we can talk about something like a teledoc. Is it going to be as necessary in a post-pandemic world? I think more people know how to use it. And as you have, look, would you rather go to a minute clinic, sit there for an hour, be surrounded by sick people, or would you rather jump on with the teledoc doctor and say, my throat hurts, strep is going around in my neighborhood, I'm allergic to penicillin, can you write me a prescription? And they say, yeah, say look into the camera, and they go, okay, yes, we're going to do that. That is a much more pleasant experience. Some of these things we've figured out, and we don't know. Are people going to pay $20 to watch a movie in their home when they could go to a theater? Is a theater a better experience, or is my living room a better experience? I don't think we know those answers yet, but there's definitely some level of shift that has already happened.
I'm just wondering, last question, Dan, in terms of, you mentioned the S&P 500, or I maybe mentioned the S&P 500, but does it make sense, and a lot of people invest in that, does it make sense to add other indices to your investing portfolio to take other segments of the economy? So as the S&P 500 and other indices become more concentrated because of this dominance, does it make sense to take a more broader approach as well? I'm not saying an either or, as well, to get retail and real estate and other manufacturing.
So without giving specific advice, I'm a big fan of owning individual stocks. So if you look at retail and say, boy, I think the real winners are Costco, Target, and Walmart, Home Depot, then buy those. But you can also buy sector ETFs. And when you buy an ETF, you want to look at the fees associated with that, because sometimes they can be significant. But in general, they should be well less than 1%, and it shouldn't be a major factor. So, let's talk about something speculative. Like if you want to speculate in the cannabis space, maybe you buy 2% of your portfolio in a cannabis ETF that gives you broad exposure. I don't recommend that particularly. I think there's only a couple of good stocks in that space, and they're much more pick and shovel adjacent plays, like Scott's Miracle Grow, rather than buying direct cannabis producers. But that said, if you want exposure in retail, find an ETF that's buying the top retailers, and you'll have exposure to all those companies I just talked about. But you won't have exposure to GameStop. You won't have exposure to JCPenney and some of the losers in the space. So diversity is good, but don't diversify just to diversify. Diversify to follow the markets and the things you believe in. If you think travel is going to bounce back, buy a travel ETF. Now personally, I wouldn't do that. I think it's going to be a long time before travel is normal. People ask me all the time about airlines. Would I buy airlines? If I had to buy an airline, I'd buy Southwest. But as much as I love Southwest as a customer, I think they face a very long road to recovery, even though they're the best run airline. So does it make sense to own more Apple and less, Royal Caribbean? Yeah, it makes sense to own more Apple. And I say that painfully because I'm a giant fan of Royal Caribbean as a customer, but not as a shareholder.
Yeah. Well, Dan, really interesting points. Really appreciate you sharing your perspective. Thanks so much for joining us on the program. And we look forward to having you back again next week.
I'll see you next week.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, and so much more, check out our daily newsletter, The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.